Floyd Garden World is not a difficult question. However, it tests whether you know IS1 and whether you've studied all the items that should and should not be disclosed under the note profit before tax or profit from operations. So let's do Floyd Garden World. Floyd Garden World was incorporated on 1 August 2015 by Floyd Green. The entity is mainly involved with the maintenance of gardens of office parks and shopping centres. The entity is registered for value-added tax, and you may assume that all VAT documentation for input VAT and output VAT are correct and kept on file. The VAT rate applicable on all past and current transactions is 15%. FG World decided on a 31 July financial year, and the commencement date and the statement of profit or loss classifies expenses according to the function of expenses method. Now, before we carry on, let's just have a look what they require from us. They want from us present a profit before tax note pertaining to the statement of profit or loss and other comprehensive income of Floyd Garden World Pty Limited for the year ended 31 July 2018. According to IAS1 presentation of financial statements, comparative figures can be ignored. And then very, very important, marks will be deducted for unnecessary information disclosed. So beware here that you don't end up with a negative mark. Great stuff. So we know what to do. It's a profit before tax note, so therefore we can write the heading Floyd Garden World Pty Limited, notes to the financial statements for the year ended 31 July 2018, and then profit before tax. Included in profit before tax are the following items, and we know that in that note we have to distinguish between income and expenses. So small heading income, small heading expenses. Great. The following information was provided to you. Inventory related information. FG World had opening inventory mainly consisting of fertilizer and topsoil on hand at the beginning of the current year, amounting to 320,900. There were no inventory write-downs during the previous financial year. Total garden product purchases per invoices exclusive of VAT for the year amounted to 1,912,000. Due to FG World's prompt payments to creditors, a total discount of 36,000 exclusive of VAT was received. At year-end, the balance for allowance for settlement discount on inventory purchases amounted to 9,800 rand. At year-end, the value of closing inventory determined through the first-in, first-out method of inventory valuation amounted to 344,000 rand. That's our closing inventory. The net realizable value was determined at 318,000 rand. Now, in this piece of information, number 1, 2, and 3 on inventory, you can actually calculate cost of sales. Opening inventory plus purchases, less all discounts, less closing inventory. What is important though, that cost of sales is not one of the items that we disclose under the profit before tax note. Cost of sales is a separate line item on the face of the statement of profit or loss. Therefore, if you showed me all this opening inventory and the purchases and the rest of it, I would have subtracted a half mark for each and every correct thing that you've written down because that was not required. What do we disclose in the profit before tax note? Only if there was a net realizable value adjustment. And there was indeed one because the cost price of closing inventory was 344,000. The net realizable value of inventory was only 318,000. So that meant that I had to write down my inventory to a net realizable value, and the adjustment being 26,000 rand. Income or expense, did it make my profit more or less? It actually reduced my profit. So as we go along, we might as well just plot it in our note. Now, there were no income in this note, only expenses. And I'm going to write it there because it is important that we do write it there. Expenses. Right. Good. So somewhere in this note, I must have had a net realizable value adjustment entry. Included in cost of sales is a net realizable value adjustment on closing inventory of 26,000 Rand. Note here again, I actually draw this line here, and on the right-hand side of the line, I do my calculations, but clearly everything that I'm going to show on the left-hand side of the line is going to look exactly what the note was supposed to look like. And for the rest, you forget it because it's not asked, it's not required from you to do anything more with that note than what you've done up till now. Admin expenses, staff remuneration as part of per the general ledger account at year end amounted to 1114,000. Included in this amount is directors' remuneration for services rendered as executive directors to the value of 450,000. Now we know that that is not staff remuneration, that is directors' emoluments, and we have to show that separately. And then there was also payments made to non-executive directors for director services of 175,000 Rand. So our actual employee remuneration was only 489,000 Rand. And now we can account for 1 and 2 in the note as well, because we know that both of them are separately disclosable items. So staff remuneration was 489,000. Then directors' remuneration or directors' emoluments, you can call it either or. You have to distinguish between executive directors and non-executive directors. And under each one of them, you must further make a breakdown between amounts paid for services as directors, amounts paid for managerial services, amounts paid for other services rendered, and then any costs that they have recovered from the entity must also be shown separately. What kind of costs can a director recover? Guys, like traveling costs. Let's say we have an overseas director on our board, and this guy has to fly in from London every 6 months for the board meeting, and we cover his traveling costs. Then obviously that would be shown as a separate cost. Now, in the question, both of those were for services as directors. So the 489, that was for executive directors, and the 175 was for non-executive directors. So executive directors 450, non-executive directors 175,000 Rand. Then auditors' remuneration. Now we know that that's also a separately disclosable item, and again for auditors' remuneration there must be a breakdown. One for audit services performed, one for costs recovered by the auditors, and the other one for other services rendered such as consultation services. So they say auditors' remuneration paid during the year amounts to 67,000 Rand for consultation services rendered. Now look at the words. That was the amount paid, 67,000 Rand. On 25 July 2018, an invoice was received from Cooper's Auditing Inc. firm. The amount per the invoice was 48,300, and that relates to actual audit services conducted during the year June 2018 and July 2018. Now, important amounts paid will include VAT. Amounts per the invoice will include VAT. So you had to remove the VAT because in the expense account you would not have shown the VAT inclusive amount. So in the note, auditors' remuneration for audit services rendered, that would have been the 48,300 divided by 1.15. And then obviously here under consultation services, it would have been the 67,000. Let's see, where am I now? There on that side. It would have been the 67,000 divided by 1.15. So you can just write it in. There. So don't let it catch you out. Amounts paid and invoiced amounts will include VAT, and there's never in your income statement a VAT inclusive or amount. Never ever. Okay, not if I'm a VAT vendor. Great. Next one. Telephone expenses in the general ledger account amounts to 92,000 Rand. It's not a disclosable item, so you just leave it out. The same applies to water and electricity charges. Rent paid as per the general ledger account for the year amounts to 155,000. I have to show rent paid. That is a separately disclosable item. And if that is the amount per the general ledger account, then the VAT would have been removed out of that amount. So here rent expense, 155,000 rand. Don't let basics catch you up. Stationery as per the general ledger accounts amounts to 24,900. That's in any case an inventory figure, and we are not going to disclose that separately, whether it's inventory because it's not profit before loss, and whether it's the expense, neither one of the two is going to be shown in this note. Now, sales and distribution expenses, depreciation, and any other expense relating to vehicles are classified as distribution expenses. Depreciation and any other related information supplied on vehicles must still be taken into account for the current financial year. So we still have to calculate all the information. Then other operating expenses, bank charges as per the general ledger account amounts to so much, and the bank statement was only printed out and revealed bank charges for July for so much, and then there was also interest charge on an overdrawn amount of 1,800. Now, bank charges is not a separately disclosable item, so if you've shown that, minus half a mark for every wrong amount that you've shown. Interest, finance cost is a separately disclosable item, but not in the note. On this face of the statement of profit and loss, I must show finance costs. So that doesn't appear in the note profit before tax as a line item. The same thing applies to repairs on maintenance and repairs on machinery or any other product or asset. That is not a separately disclosable item, so that shouldn't appear anywhere. And then all machinery-related expenses, inclusive of depreciation, must be categorized under other operating expenses. Depreciation on machinery must still be provided for. Great, then our property, plant and equipment. Let's look at property, plant and equipment related information. Vehicles. FG World owns 2 delivery vehicles. The Toyota was purchased on 1 September 2016 at a cost price exclusive of VAT of 590,000 rand. At acquisition date, it was estimated that the vehicle will have a VAT exclusive residual value of 50,000. Then that same Toyota was traded in on 1 October 2017 on a new Ford Ranger, which had a total invoice price of 684,250. An electronic transfer of funds amounting to 373,750 was done to settle the amount due on the Ford Ranger. The estimated residual value on the Ford Ranger was estimated at 85,000 rand exclusive of that. All vehicles are depreciated by making use of the straight line method at 25% per annum. Great, so let's have a look at this Toyota. It was purchased on the 1st of September 2016. The cost price exclusive of that 590,000. It was sold on 1 October 2017. So that means that we have used that specific Toyota for a period of 20 months, if I can remember correctly. So let's have a look at the calculation. Here's the Toyota. Cost price 1 September 2016, it was 590,000 rand. Now I have a lot of these things here. That one is Afrikaans one, yeah. The estimated residual value was 50,000 rand and the depreciation 25% per annum on the straight line method. So 590,000 less the estimated residual value multiplied by 25%, and as from 1 September 2016, the acquisition date, up to 31 July 2017, the first year end or the year end as at the beginning of the current financial year, a total time period of 11 months has gone past. So therefore the depreciation up to the beginning of the current year was 123,750, and that gave us a carrying value at the beginning of the year of 46,250. We have sold this vehicle or traded this vehicle in on 1 October 2017. Now, from the 1st of August 2017 up to the 1st of October 2017, we have used that vehicle for a period of 2 months. So 590,000 again, less the estimated residual value multiplied by 25% for 2 months period gives you depreciation for the current year of 22,500, and they've told us they haven't accounted for it as yet. Then they tell us in the question that we have purchased or traded in for a new Ford Ranger, and the Ford Ranger had an invoice price of 684,250. So invoice price will include that. We have, however, only had to pay in an amount of 373,750 to get this Ford Ranger. So the difference between the 684,250 and the 373,750 must be the proceeds on the sale of that vehicle. But that will be the VAT inclusive amount. So if we're going to remove the VAT exclusive proceeds on the trading transaction is 270,000 rand. So that means that we've made a loss on that trading transaction of 173,750. Now, losses on the sale or disposal of any asset must be shown in our note. So we've worked out that we're still in the progress of doing the depreciation, but it's the only asset where we actually have a loss on, so we can go and disclose that in our note. Loss on disposal of vehicles, 173,750. Right. Then they've said that we have purchased the new Ford Ranger on 1 October, and this invoice price was 684,250. So for the Ford Ranger, the VAT exclusive cost price was 595,000 rand. They also tell us that the estimated residual value on the Ford Ranger was estimated at 85,000 rand. And remember, it must always be a VAT exclusive amount that you're working with. So we have to subtract the 585 to get the depreciable amount and then work out 25% depreciation for the number of months that we've used the Ford Ranger, which was 10 months. So 595, the VAT exclusive cost price, less 85,000, the estimated residual value, multiplied by 25%, multiplied by 10 months, give us then total depreciation on the Ford Ranger of 106,250. Then there was one that I skipped, and that was the Isuzu. We had an Isuzu which was purchased on 1 February 2016 for 630,000, and that is a VAT exclusive amount. The estimated residual value was 50,000 rand exclusive of VAT. So it's a straightforward calculation. What is going to be on the Isuzu? 630,000 less 50%. We've used it for the full year, 25,000. So that gives us depreciation on the Isuzu of 145,000 rand. So total depreciation will then be the 22,500 plus the 106,250 plus the 145,000, which gives us in total 273,750. Now depreciation, we know we have to show per class item. So we would have had depreciation on vehicles, and the total there, 273,750. Then machinery. All machinery from the date of acquisition must be depreciated on the straight line method over the estimated economical lifetime of 4 years. Machinery consisted out of 10 lawn mowers and 10 weed eaters and were all purchased on 1 December 2016. The lawn mowers had a total cost, not per lawnmower, in total all 10 of them costed 180,000 exclusive of VAT. And the weed eaters had a total cost, also exclusive of VAT for all 10 of them, of 90,000 rand. At the date of acquisition, the financial manager made a decision not to provide for any residual values on the lawnmowers nor on the weed eaters. New information came to light during the current financial year, and it was decided to take into account residual values on both the lawnmowers and the weed eaters. The lawnmowers are deemed to have an estimated residual value of 2,000 Rand per lawnmower. So there are 10 of them. So what is the total estimated residual value? 20,000 Rand. And the weed eaters of 1,000 Rand per weed eater. So how many weed eaters? There are 10 of them, so it is 10,000 Rand. After some investigation to the useful life of the lawnmowers and the weed eaters, it was found that the remaining useful life as at 31 July 2018, at the end of the year, was 16 months. Right. The change in estimate will have to be recorded by the application of the cumulative catch-up method. So what we have to do is to work out the carry value based on the old method of depreciation on this lawnmowers and weed eaters up to the 1st of July 2017. 1st of August, sorry, beginning of the year, 1st of August 2017. Then we had to work out what was the total depreciation charge based on the old method, because we have to disclose that, in the profit before tax note, original estimate for the year 2018. And then we have to apply the new information on the same asset as since the acquisition date, because we have to apply the cumulative catch-up method. Let's just have a look. What was the total lifetime now under the new estimate of this specific lawnmowers and weed eaters? They say the remaining useful life at the end of the year was still 16 months. In the current year, 12 months has gone past. And from the acquisition date, which was the 1st of December 2016, up to the beginning of the current financial year, which was 31 July 2017, a total of 8 months has expired. So from the acquisition date up to the beginning of the current financial year, there was, since acquisition, up to the beginning of the current financial year, there was 8 months that we've used the asset. Then we have used the asset for this full 2018 financial year, 12 months. And at the end of the year, so from 31 July 2018 up to the end of the lifetime of the asset, there are still 16 months left that we can use. So in total then, 16 months plus the 12 of the year, plus the 8 months since acquisition date up to the end of the first financial year gives us in total 36 months, which is the estimated lifetime, the new estimated lifetime of the asset. The 36 months divided by 12 gives us an estimated lifetime of 3 years. So let's quickly have a look at it. The total cost of the lawn mowers, according to this thing here, was 180,000. Total cost of the weed eaters was 90,000. So you have to do lawn mowers, weed eaters separately and a total. Lawn mowers, weed eaters separately and a total, because the things are different from each other. The estimated residual value here is going to be different. Great stuff. So accumulated depreciation up to the beginning of the current financial year, because our first stop is our carry value at the beginning of the year. It's going to be 180,000 times 25% for the 8 months that we've used it from the acquisition date up to the beginning of the current financial year. It gives us a 90,000 times 25% times 8 months for the weed eaters. So in total, we have written off 45,000 Rand of depreciation on the lawnmowers and the weed eaters up to the beginning of the year. That then gave us an actual carrying value of the machinery, if you want to, at the beginning of the year of 225,000 Rand. If we did continue with the old way, we would have written off 25% on 180,000 on the lawnmowers and 25% written off on the cost price of 90,000 of the weed eaters in the current year. So if we did continue with the old way, we would have written off 67,500 Rand worth of depreciation. Now under our new way, we said, well, this is again our cost price, 180,000 and 90,000, in total 270,000. But now we have an estimated residual value built in of 20,000 Rand for the lawnmowers and 10,000 Rand for the wheat eaters. And we have now a revised estimated total lifetime of each of 3 years. So 180,000 less the estimated residual value divided by the total estimated lifetime of the asset of 3 years multiplied by 8 months usage in the first year would have given us 35,556. Depreciation on the lawnmowers, 90,000 less the estimated residual value of 10,000 on the wheat eaters over the estimated lifetime of 3 years multiplied by the usage of 8 months would have given us 17,778. In total then 53,333. So based on the new method, our carrying value of this asset would have been in total 216,667. So what is now our catch-up depreciation? Our catch-up depreciation is going to be the difference between 53,333 and 45,000. Is it going to be an increase in the expense or is it going to be a decrease in the expense? I want more accumulated depreciation than what I've passed in my records. Therefore, I'm going to debit depreciation with a difference of 8333. I'm going to credit accumulated depreciation with 8333. I could have also taken just the carrying value as it is in my books, opposed to the carrying value what I wanted it to be in my books. So 225 less 216,667, that is also equal to 8333. So that's my catch-up depreciation. Now, if I'm going to continue then with my new way, apply my new estimates for the current financial period, again, it's going to be 180,000 less 20,000 divided by 3. 91,111 on lawnmowers, 90,000 less 10,000 divided by 3 years, 45,446. So my actual depreciation charge is going to be, that is 80,000 Rand. 80,000 Rand, that is our carry value. So there's our depreciation. 53,333 on lawnmowers, 26,667, so in total 80,000. These figures here is our carry value at the end of the year, which I don't need for this purpose. So our total depreciation charge is then going to be our catch-up depreciation, the yellow one of 8333, and the actual depreciation, the turquoise one of 80,000. So in total then 88,333. Going back to your note, total depreciation on machinery 88,333. Going backwards here. 88,333. Can you see? It's that figure there. Great. Now I must break it down. I must say original estimate would have been how much? Original estimate would have been how much? And here that figure is 67,500. If I did continue the old way, it would have been 45,000 on the lawnmowers, 22,500 on the wheat eaters, so in total 67,500. It is original estimate 67,500. And then now the change in estimate, well, we have worked out the 88,333. So clearly the difference between the 88,333 and the 67,500 equals our impact of the current year's profits of 28,33. It's a nice question. It's not a difficult question. Make sure that you actually understand where all the figures are coming from. Make sure and go and study your set of illustrated financial statements to make sure that you are not going to disclose things that you're not supposed to disclose. Sorry, I forgot the last paragraph. It's about land. FG World owns land that was purchased in 2016 for 270,000, exclusive of VAT. The intention is to build a warehouse on this land, which will only take place in 2019. During the current financial year, sworn appraiser B&S Appraisers valued the land at a fair value of 350,000. The directors elected to measure the land at its revalued amount at year end. Now, guys, obviously there was a revaluation that took place. What is the accounting entry? I will debit land with 80,000. I'm going to credit a revaluation surplus with 80,000. That revaluation surplus is going to be shown as part of other comprehensive income on the face of the statement of profit and loss and other comprehensive income, and also in my statement of changes in equity. Obviously not in the profit before tax note, so you ignore that piece of information for the purposes of this question.